If you have been investing in stock markets, you must have been paying attention to the worldwide stock markets index as well. But you know what the index really is and what the components of the index are. Actually, the index is a trend indicator of a basket of assets which could be designed according to stocks, commodities, regions, countries, sectors, currencies, or real estates. The index is aimed to provide investors with a representative reference for a particular type of assets. There are different indices used in different countries and regions as reference, such as the US S&P 500, the Japanese Nikkei 225, the Germany DAX index, and the Chinese Shanghai Composite Index. Each index has its own calculation methodology. We use different methods to track different indices. For example, Shanghai Composite Index is calculated by all stocks listed in the stock market. Apart from calculating all stocks, some indices only use a few dozens or a few hundreds of representative stocks to constitute the indices. Standard & Poor's 500 Index is one of the examples. It is constituted of 500 stocks, and the trend is determined by the stock prices. So, what are blue chips? As we have mentioned, some indices only use a few dozens or a few hundreds of stocks to track the respective index. Take Hong Kong Hang Seng Index as an example. It is calculated by 50 representing stocks, and these 50 components of the index are called the blue chip stocks. The criteria of adding the stocks into the index are based on the market value and turnover. Equity index will do a time-to-time review on the stocks and adjust the number and weighting of the stocks. For the time being, in Hang Seng Index, Tencent Holdings has the highest weighting percentage and followed by HSBC Holdings in Hong Kong. As Hang Seng Index covers 70% of market value of all listed companies last year, it can be seen as a reference and also an important economic indicator. The United States had three major indices: the Dow Jones Industrial Average, the Nasdaq Composite Index, and the S&P 500 Index. S&P 500 Index, which was founded by the Standard & Poor's in 1957, is the second largest index after Dow Jones Industrial Average. Compared to the other two US indices, S&P 500 Index selects 500 stocks from different US industries with the highest market value. It also includes different industries such as Apple, Nike, and Honeywell, which people are familiar with. That is why the trend of the index is relatively stable and is representing of the overall market. Being different from S&P 500 Index, the Shanghai Composite Index is listed on the Shanghai Stock Exchange. All listed companies are the components of the index. Once a company is newly listed on the Shanghai Stock Exchange, the price-earning ratio will be adjusted as well. The Shanghai Composite Index is officially announced on January 15, 1991. The base date is December 19, 1990, and the basis point is 100. Although Shanghai Composite Index started later than those indices in other countries, it is developing with China's rapid growth in the economy in recent years. With the addition of huge trading volume, many investors are taking notice of the trend of the Shanghai Composite Index. Many investors are taking notice of the trend of Shanghai Composite Index. So, is an equity index useful as a reference? The major function of indices is a trend to provide investors with a sense of the overall market. Of course, it cannot be ensured that all stocks will rise when indices rise. The relation is more like a pet owner and the pet. The index is the owner, while the stocks are the pets. Different pets have different temperaments. Some would be more active and like to run around, while others might follow the pace of the owner. However, the owner always leashes up their pets, and eventually, the general direction and pace of the pets will still depend on the owners. In other words, the trend of the stocks will eventually be affected, but it may fluctuate in certain volatility. In fact, according to historic statistics, when the indices rise, 70% of the stocks will follow, while 90% of the stocks will follow when there is a decline. Thus, apart from selecting a good pet, watching the market trend is equally important.